My next guest says she's still expecting 2 rate cuts this year. Joining me now is Diane Swonk, chief economist at KPMG. CNBC senior economics reporter Steve Leisman is here with us as well. Welcome to you both. Diane, there are some firms, I think Bank of America now expects no rate cuts this year. Make the case.
Well, I can't make a strong case for 2 rate cuts. I think that we have a couple scenarios, and one of them has only 1 rate cut with a very low probability of that actually occurring, depending on the outlook for tariffs. And you're seeing that in consumers' reaction to tariffs, both in December and early January. As you pointed out, the consumer sentiment sort of expectations of inflation front-running tariffs, which is its own self-fulfilling prophecy. If they actually act on those decisions to buy, that will push prices up. And so that's something we're watching very closely. So it really is dependent on policy and where we go from here. That said, this was a great employment report. That's good. It does contradict some other private sector reports that showed a more cooling in the labor market during the month of December. And so 1 month does not a trend make. And I think some of the market reaction is a little bit too overly weighted on how much inflation is embedded in that employment report.
Especially, and we'll get into this maybe a little later on, but if a lot of this is on the expectation of tariffs, which have a different inflationary effect. I mean, last time around, they ultimately were a little bit contractionary, disinflationary. But what were those points, Diane, that you see, that you think tell us there's other signs of a labor market that's actually softening? I'm curious.
So what we've seen is, the hiring rate has fallen precipitously. The reason we've not seen a lot of increase in unemployment is that layoffs are also low. That's good. The quit rate has fallen. Now, in the month of December, it suggested a reversal of that, but 1 month does not a trend make. That's great if it is the beginning of a new trend, but also bad in terms of a reacceleration in potentially wages to the point of it being worrisome for the Fed. I think the underlying weakness that we're seeing in other indicators, everything from the ADP report to the Indeed hiring index, a lot of these real-time indicators that have been very closely correlated with the overall labor market conditions have now, in this month, broken apart. And so it's hard to sort of square that. And I think the one concern I have is that some of what we're seeing was also because the holiday season was all compressed into the month of December. We saw hiring by retail, not in November, but in December because of that later than usual holiday season. It was a good holiday season and a strong end to the year. That is good news for the consumer. It is somewhat worrisome for the Fed, especially given how many people were out on vacation during the survey week, which was before a record holiday travel season.
Steve, where are you watching?
Well, I want you to reread the top of the show. We were so glum about 256,000 jobs added. The unemployment rate sank by 1/10 to 4.1% with some exuberance, Ms. Evans. These are good numbers. Plus, you just heard what Diane said about the retail. The December holiday shopping was good. I think what the market's coming off of, I have a theory on this. Now, slap me down if I'm wrong on this. The market thought it was going to get a freebie. Thought it was going to get strong economic growth
and
a Fed that was going to. You're not going to get your cake and eat it, too, and the market's coming to terms with that. I never know where the right valuation is here. The question is the Fed too loose? I don't think so. I had some conversations with some people
Were you guys
in
talking
San
about
Francisco. We were all talking about it.
Even before this report came
and
out.
whether or not the Fed ought to have cut. I think there's still a case to be made for the Fed to be on or around where it is right now. A quarter up, a quarter down, I don't know. We had Goolsbee on today. He told us this morning he thought the Fed...
He didn't walk it back, really.
He didn't walk it back. He still thinks the Fed will be a fair bit lower. Fair bit was the phrase he used there in 12 to 18 months. So I think the market's coming to terms with the idea that it's not going to be a freebie. We're going to have to value these stocks based upon a higher rate or even a higher neutral rate because, as you know, productivity is higher. You have this potential boom. There's some people that thought they looked at the numbers this morning. Joe Livornia was among them. He thought he saw maybe a little Trump boom in the employment numbers. I talked to some other economists about that. They think it's too early for that.
I noticed that manufacturing was negative.
That was something you would expect to be higher. You had
in the long run.
If you look at where the jobs are full screen that I put together, guys in the back, you'll see that we had some of the so so good in the back.
There's
Some of the
that retail
likely
number.
suspects in there: 70,000 for health assistance, retail, leisure and hospitality. Retail was higher. State and local government, that's been a big source. And there's that manufacturing number. Reading your mind, Kelly, putting that on there, minus 13.
Because it jumps out. I mean, when you
does.
go, okay, that's not a great sign.
But it would be a thing that if it was a Trump boom, either from tariffs or whatever, you'd expect that number to be doing better. Yeah.